Hey there, ready for another deep dive? We're digging into Capital Power Corporation's second quarter report for 2024, and we'll be focusing on what investors should be taking away from this.
Sounds good. Let's jump right in.
All right, so Capital Power is celebrating being 100% coal-free, which is a big deal. They actually completed this transition 5 years ahead of their deadline.
Definitely. And their Genesee generating station in Alberta is now fully powered by natural gas.
Right, it was a pretty big undertaking. Switching from coal to natural gas at Genesee, definitely not cheap.
Yeah, the Genesee repowering project is looking at a cost projection of 1.55 to 1.65 billion dollars.
Wow, so a lot of money on the line. The report mentioned they've achieved simple cycle operations for units 1 and 2 with the goal of combined cycle completion soon.
Hmm.
So for those who don't know much about power plants, can you break that down a little?
Sure. So basically, they're making the plant even more efficient in how it generates electricity. Simple cycle means the plant is only using the gas turbines to generate power, whereas combined cycle captures the waste heat from those turbines to produce even more electricity.
Got it. So it's like getting more bang for your buck in terms of energy output. And speaking of bucks, these rising costs for the project must have investors a little bit concerned.
Yeah.
How is Capital Power addressing that?
Well, they recently secured $450 million in funding.
Okay, and where did that funding come from?
They issued a 30-year hybrid bond.
A hybrid bond. That sounds interesting.
Yeah, it's actually the first of its kind in Canada. It combines features of both debt and equity financing, so it's a pretty unique approach for the renewable energy sector.
So that fixed interest rate of 8.125% is actually quite competitive right now.
Yeah, exactly. And this bond gives Capital Power some flexibility with their finances over the long term, which is important for these big projects.
Absolutely. Now let's talk about the dividend increase that was mentioned in the report. What's the significance of that for investors?
So they announced a 6% increase, bringing the annual dividend to $2.61 per share. This is a good sign for investors because it shows that Capital Power is confident in their future earnings. They seem to be trying to strike a balance between investing in clean energy and making sure their investors are happy.
It's a good sign that they're committed to rewarding their investors.
Yeah.
But how sustainable is this strategy in the long run? I mean, the energy market can be pretty unpredictable.
That's the big question, right? And to answer that, we really have to look at Capital Power's overall strategy. They're not putting all their eggs in one basket with Genesee. They're also expanding in the U.S., which comes with its own set of opportunities and risks.
Let's dive into that U.S. expansion a little bit. Their report highlighted their acquisition of natural gas facilities in California and Arizona.
Right, La Paloma in California and Harquahala in Arizona, those are some significant acquisitions.
And they're locking down long-term contracts for solar projects in North Carolina. So they're diversifying their portfolio. What's the strategy behind that?
It's all about spreading the risk. The energy market is constantly changing. So having a diverse portfolio across different regions and energy sources is key to long-term stability.
It seems like they're aiming for that balance of natural gas renewables, and with Genesee, they're completely coal-free now. What does this say about their long-term vision?
I think they're trying to position themselves as leaders in the transition to a lower carbon future. And that's appealing to a lot of investors who are looking for companies that align with their own values around sustainability and clean energy.
But the report did mention some challenges too, right? Specifically, lower captured power prices in Alberta. What does that actually mean for Capital Power?
So basically, Capital Power is receiving less revenue for the electricity it generates in Alberta.
And why is that happening?
It's a complex issue with a lot of factors, but it's definitely a concern for Capital Power, especially as they bring the Genesee repowering project online with its higher operating costs.
So investors are probably going to be watching that very closely.
Oh, absolutely. They'll want to see how Capital Power handles these lower prices. Will they be able to make up for that lost revenue with their U.S. ventures? Do they need to adjust their dividend strategy? These are all questions that investors will be considering.
It sounds like Capital Power is juggling a lot right now. They've got these big, ambitious projects, but they also need to maintain those profits and keep their investors happy. And then there's a whole regulatory landscape to consider, which is always changing, especially in the energy sector.
You're right. Regulations around emissions, carbon markets, it's constantly evolving, which adds another layer of complexity for Capital Power. Investors will want to see that they're able to adapt to these changes quickly and effectively.
So they need to be flexible and proactive. It's a lot to manage. What does this mean for someone who's thinking about investing in Capital Power right now?
It's all about carefully weighing the risks and potential rewards. Capital Power has a lot of positives, their commitment to clean energy, their strategic diversification, but the financial implications of these projects, especially Genesee, need to be considered very carefully.
So it's a balancing act.
Yeah, it's all about finding that balance.
So what are some things investors should be watching for in the coming months, maybe even weeks, when it comes to Capital Power?
I think keeping an eye on the progress of the Genesee repowering project is key. Can they stay on schedule?
That's a big one, with so much money invested in that project.
And within budget, too, even with the revised projections. And then beyond Genesee, how Capital Power integrates their recent U.S. acquisitions.
Right, because those are already up and running facilities.
Exactly. Are they able to make those work well with their existing portfolio? Are they achieving the synergies they were hoping for? Those are things investors will be looking at.
So they'll need to prove they can make those acquisitions profitable.
Absolutely. And let's not forget about their renewable energy projects. Investors will be watching to see if they're actively pursuing new contracts in that space.
Are they expanding into new areas of renewables? Because that will really show their commitment to a cleaner energy future.
Exactly. Actions speak louder than words, right?
Right.
And then, of course, there's those captured power prices in Alberta. Do they rebound, or does Capital Power need to make some changes to compensate for that?
It's a lot for investors to keep track of.
It is. Capital Power's in a really interesting position right now. They're making big moves, but there are also risks involved. It'll be fascinating to see how it all plays out.
Capital Power, definitely a company to watch in the energy sector. Any final thoughts for our listeners before we wrap up?
I think Capital Power's journey is a great example of the challenges and opportunities facing the entire energy industry. It's a time of transition, and companies need to be adaptable and forward-thinking to succeed.
So pay attention to what Capital Power is doing, not just what they're saying. Look at their actions and their results.
That's a great takeaway.
Well, that wraps up our deep dive into Capital Power Corporation's second quarter report for 2024. We've covered a lot of ground, from their coal-free achievement to their expansion into the U.S. market. As always, thank you for joining us on this deep dive, and we'll catch you next time.